In this video, we're going to look at First Majestic Silver, and this is a Canadian silver mining company that operates in Mexico. And what I do in my videos is I try to figure out the value of a company using their prior financial information and looking at their capital structure. Then at the end of the video, I look at the financial ratios of the company to get more information. This company trades on the New York Stock Exchange with ticker AG, and that's what we're looking at in this video. They also trade on the Toronto Stock Exchange, ticker FR.TO. They also trade on the Frankfurt Stock Exchange, ticker FMV.F. Also on a different Frankfurt exchange, the ticker's FMV.DE. I think DE means Deutsche. They trade on another German stock exchange in Stuttgart, Germany, FMV.SG. They also trade on the Munich Stock Exchange, FMV.MU. And they also trade on the Berlin Stock Exchange, FMV.BE. It's possible they even trade on more exchanges, but this is just what's visible to me on Yahoo Finance. When a company trades on multiple exchanges, it doesn't matter where someone buys the stock, it's the same exact amount on all the exchanges. It is costly to trade on multiple exchanges because there are fees to be listed, but it adds liquidity to your stock. More people are buying your stock, which in theory may drive the price up. So let's get started with the model. This company has a market cap of $2.194 billion. And their stock price is $10.43. So this is the New York Stock Exchange, so everything is in US dollars. And we need their free cash flows because the way you value a company is you estimate the future free cash flows and then you discount that number back to today. And that's what I'm doing in the video. Next, we need the net income, which is the profit and loss on the income statement. Now I'm going to pull the revenue, which are the sales, and put that into the model. And this company has a lot of negatives, so it does make it a little harder to value. So I had to use a more conservative model. Let's look at a capital structure so we know what discount rate to apply to the future cash flows. They pay $12 million of interest on their debt. That's on the income statement. Let's go to the balance sheet to see how much debt they have. And current debt of $1.1 million, that's debt due within 12 months. And long-term debt of $154 million, that's debt due after 12 months. They pay 7.7% interest on their debt, which is a really high interest rate. I just put a 20% tax rate because I couldn't find their effective tax rate on their income statement. So the cost of debt is 6.2%. Let's get the cost of equity. We need the beta. That's how much the stock moves relative to the market. 1.37. So the stock moves a little more than the market does. Next, we need their current assets. And we need this because when we look at the current ratio later, that's part of the calculation. And current assets are cash, accounts receivables, and inventory. That's $243 million. And we also need current liabilities for the current ratio. These are debts and payables that are due within 12 months. That's $72 million. And the equity, that's $662 million. That's assets minus liabilities. We need the equity number for the PB ratio and also for the ROE calculation. Now we need EBIT, earnings before interest and taxes. That's called operating income on the income statement. That's $23 million. We need this number for the interest coverage ratio later. Let's look at the capital structure. The debt costs 6.2% and they have 19% debt. The equity costs 12.8% and they have 81% equity. So the WACC is 11.6%, which is a combination of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $1.6 billion. We divide that number by 210 million shares and we get an intrinsic stock price of $7.40. It's trading at $10.40, So it's trading at a 41% premium. So it's a sell according to the model. Let's see what Simply Wall Street says. They're in the other direction. They're saying the stock is worth $16.80. So like I said, it's hard to value a company with a lot of negatives. So I try to use a more conservative approach, but they may be looking at other factors. So I don't have too much experience valuing silver mining companies. And if I do more videos on silver mining companies, my model should improve. Let's look at the historical stock price. And it looks like it was trading about $16, $17 a few years ago. Then it dropped. And it looks like it's been on an incline since coronavirus. This could be a really good stock because silver may be very costly in the future if the dollar falls with all this inflation and printing of so much money. Let's look at the financial ratios. They have negative PE because they have negative earnings, negative income. They don't have a good price to sales ratio. It's 5.9. That's price to stock over sales per share. They have a decent price to book ratio. That's price to stock over book value per share. They're doing well in current ratio. They can cover their current liabilities. They have a negative ROE because they have negative income, and that's income over equity. They can only cover their interest payments 1.9 times. So after they pay interest expense, they don't have that much left over. And debt of 19%, which is pretty low. So let me know what you think of the video. It's an interesting company to look at. Thanks for watching.